Kamal, do we have you?
Hi, Matthew. Hopefully you
Hi,
can
Kamal.
hear me.
Excellent.
There we are. Brilliant.
Brilliant. Okay, well, look, thanks for joining us today. Really appreciate it. I know we've had you on before, and it's always a sort of great, interesting discussions. Just want to give us a couple of minutes, just tell the guys that are listening sort of what you do and what your sort of role is there, and then we can perhaps sort of move on and talk about your sort of thoughts on the world at the moment.
Yeah, absolutely. Well, firstly, thank you for having me on the panel. As it sort of states there, really, I head up the equity fund research for Canaccord. I cover both open and closed-ended funds from a research perspective. I chair both of the individual committees that we have at Canaccord. I also have an input into our asset allocation committee with regards to the equity portfolio and how that is, how it looks, how it's structured, and that's essentially me in a nutshell. So all things equity fund related, really.
Excellent. But I suppose interesting place to start is, are there sort of any areas that you're finding particularly interesting at the moment? I mean, obviously there's a lot of uncertainty in markets. We obviously got headwinds of, potentially a little more in the way of rate rises, but the sort of investing landscape has sort of changed quite a lot, say during the last couple of years. I mean, sort of what have you been doing with your portfolio? Is there anything areas that you've liked? Has there been much change? Can you perhaps sort of talk us through some of that, please?
Yeah, absolutely. I think let's start from kind of the key risk factors and that sort of point of view. So stylistically, we've definitely become more neutral over the last couple of years. We definitely had a small growth bias through the last cycle. We have been conscious of that bias and tilted portfolios to sort of style neutrality. That has benefited portfolios, of course, through this period. As we know, investors have become much more focused on shorter duration cash flows. We hear that comment all the time. In effect, that means dividends in the equity landscape and getting cash flow received a lot sooner than as a growth company, you're expecting cash flows to be further out. So we've been conscious of tilting towards a more neutral style base. We've got a marginal overweight to small and medium-sized companies. I do say marginal and emphasize that, but we are conscious that small and mid caps have sold off significantly over the last few years because of that lack of risk appetite. We saw an interesting stat, actually, that 2022 was the worst relative period of performance of the FTSE 250 compared to the 100 since the indices were actually constructed back in the 80s. So
wow.
It was an incredible time for relative returns for the medium-sized companies of the UK, and that was echoed around the world. Really, it didn't really matter what style you were tilted into in the small and medium companies. It mattered at the top end. If you were kind of large and value, you had a good time, but further down the cap spectrum, it didn't really matter. It was risk off. So that's been incredible, and we've noted that, and we've tried to allocate a bit more to smaller mid caps where appropriate, where the valuations are giving you some protection. So the UK smaller mid cap scene looks incredibly attractive today, relative to most other regions in the world. It's largely been left behind and forgotten about because of political turmoil in the UK, because of the issues that we know about in the economy, not least. So, but elsewhere, from a regional perspective, we are and continue to be underweight the US. We think that
really,
we're marginally underweight. We think that valuations are still quite toppy. Yes, the headline forward price to earnings has come down a bit in the US, but you're still looking at about 19 times forward earnings on the S&P. Earnings have been okay. Certainly, you look at mega cap tech, they've been okay, but there are signs of stress underlying, and we have to be conscious of that. Credit conditions they've deteriorated. So,
so you probably just feel that quite a lot is priced in at 19 times already. Is that fair, or?
Yeah, I think we have to say that under the bonnet, if you look at the equal weighted S&P versus the kind of heavier top heavy S&P index, you get a different picture. So there's been a lot of pain underlying. The FANGs or the mega cap tech stocks have been acting and trading more like staples, defensives, that people are after those cash flows. And I think that will be the last shoe to kind of fall, really, in a situation where we go into a deep downturn. No picture is the same as history, but we're probably not going to get a massive collapse in the share prices there. We understand that, but we do think there is the potential for a further leg down in US equities.
Yeah, no, sort of fair enough. I mean, just on the subject, you sort of mentioned the UK there, and we've been doing some work on small caps recently, and traditionally, sort of globally and UK, arguably because of their superior sort of growth prospects over the longer term, they tend to have a higher rating, tend to sort of trade at a premium to sort of broader global or UK equities, if you like, and that sort of seems to be the reverse at the moment. Just thinking specifically of the sort of UK, we've had the Brexit overhang, all of the political turmoil. I mean, some examples you can see, some assets definitely look cheap, and it's attracting interest of overseas buyers. But do you think there is so much in the way of a near-term prospect of a sort of re-rating for the UK market, or do you still think there's a lot of uncertainty out there?
It's a great question. Some of the data that you look at that can give some indications of a potential re-rating is how much pain have we already had, and where are people positioned currently? Well, the UK is still, certainly the mid-cap area is still unloved, and allocators are not, they've broadly taken out their positions now. I think you're kind of there or thereabouts at sort of the bottom in terms of optimism. So we're kind of the pessimistic side of the barrel. You've seen the Bank of America Merrill Lynch report the fund manager surveys, and there's some stark data in there that people have hated the UK for many years, or international allocators have just not bothered. Why would you bother with the pain? What will happen, though, is, as you say, you've got private equity that's been sniffing around. There's a lot of cheap assets there. People are trying to take stuff private. That will be arbitraged away. But also, things have got quite silly in terms of the discounts. We're at the widest average level of discounts in the post-08 environment for investment trusts broadly. And in the small cap space, that's really extreme as well. So
it is.
There's a lot of stuff there that kind of points you towards the fact that at some point we'll see a turn. I think what drives small caps is liquidity, and you get that from when the risk appetite turns, and that's the Fed. Ultimately, if you see a pivot in the global rate cycle, we should see an appetite for risk again across the board, and people will start to allocate again into those areas.
No, that makes a lot of sense. I mean, obviously, talking the Fed, talking of the US, obviously we're now sort of starting to warm up for election. I think when I last looked, Biden's still favorite, etc. But does that impact your asset allocations, at least in the near term, at all? Do you think there's a bit more uncertainty there, or?
Yeah, I mean, we do of course consider the political landscape, especially when it comes to certain laws and what may be acted on in terms of the next couple of years, and of course geopolitically the kind of China relationship, who's going to have a better relationship with China, and that sort of thing. So we do consider it's not the driving force of our allocation. We do try and keep to kind of fundamentals, valuations, and earnings prospects, etc. But I mean, there's always something in politics land, isn't there? And
absolutely,
some potential mine that we could step on. Yeah,
absolutely. I suppose sort of on that basis, are there any other sort of areas that you're overweight that you think are particularly interesting right now?
Yeah, we like Japan. We think Japan is a fascinating story, and I've said this a bit recently, and you know, I probably sound like a broken record, but I think the Abenomics changes back in 2013, I think they're coming into fruition now, and they're accelerating. The reason I say that is because it seemed like it was largely philosophical and theoretical before. In the last couple of years, the Japanese government have made legal changes to the stewardship code, the corporate governance code. The TSC just a few months ago shook up the entire market in Japan and said to all the companies that if you've got a book value below 1x, you've got to report to us how you're going to change that, and you've got to actually do something about it, or you're probably going to get kicked out of the higher quality end of the index. And you know, there's huge change, transformational change.
That is fundamental, isn't it?
Yeah, absolutely. So we like Japan. We think it's a good bottom-up story. Yes, we know about the demographic issues there. That's well covered. But another key change in Japan is the propensity for people to accept higher inflation. The wage growth levels look a bit stickier. That's really interesting because it hasn't happened for decades. No. Suddenly, people are getting some increase in their wages. That looks good to us.
I mean, perhaps a sort of slightly difficult question. Do you think that perhaps a little bit of positive inflation for Japan would be a good thing?
It's what the Bank of Japan have said, and they you know, they're not going to increase rates anytime soon. They want inflation to come through. Let's bear in mind that Japan has only just really reopened from COVID at the back end of last year. They're way behind the rest of the world in terms of that cycle. A little bit of inflation will do Japan good. It means that corporates can increase prices, they can increase wages, people will feel confident about spending again. We just haven't seen that for such a long time. Yeah.
No. And I suppose sort of when you're looking at Japan, obviously you've got these long-term, you know, positive corporate sort of governance trends. When you're sort of looking at funds, are you perhaps looking at those that, because there are a sort of cohort of broad Japan funds, but then you've got those that are really actively engaging to try and effectively get some of these great sways of cash sort of that are sitting on balance sheets and, you know, all manner of complicated sort of cross holdings undone to extract value. Are you sort of focusing more on those, or is there sort of no real bias?
Yeah, another great question, and you know, just to kind of put the stat out there, Japan has the highest level of net cash to market cap ratio in the world. You know, it's incredible. There's something like 50% of the market cap of the index is net cash. So we have a couple of different options on our panel, and we've actively tried to capture a couple of different managers, some who are giving you that there's so many different ways to skin the Japanese cat. You've got that sounds interesting, isn't it? But the new Japan, which is all about targeting technology, demographic change, and then there's old Japan, which is the exporters, the industrial side of things, and that because industrials are a huge component of Japan's index. So we acknowledge that, and we also acknowledge what you're saying as well. It's the highest level of activist engagement in Japan that there ever has been from international investors. We want to be a part of that. So we do have strategies that actively engage with companies that have that ability to make change and realize that value sooner. But it depends how we want to play it. Right now, in our models, we do have a broader Japanese fund, a strategy that on the open-ended side that does cover a bit of everything at the moment, and it's working extremely well. I think you also have to be mindful of one thing. I do want to caveat a lot of this with Japan. Whilst you have got all these amazing things going on, you want to make sure you are in an active manager, and you want to make sure you are on the right side of that, because Japan still has a lot of value traps. There's a lot of structural decline, and no amount of engagement in some cases could help some of these companies. So it's but broadly speaking, positive Japan, we're playing it in a broad manner at present to capture a wide opportunity set and the reopening.
Excellent. I suppose I've got a sort of follow-up question that we've sort of had come through here. I mean, it's a sort of broad question about what do you think sort of makes a good manager. I think it's a sort of general question, but perhaps within Japan, is there sort of something that you could give as an example there? Obviously, as we're sort of talking about it, and you've got these sort of quite different funds as well.
Yeah, what makes a good manager is the it's the question that defines my job, I suppose. Yeah, so there's two sides. There's the qualitative and the quantitative side, where the way that we look at managers, there's certain metrics that you can look at that can tease out whether a manager has skill. And on the kind of data side, we can look at all the ratios, the risk-adjusted return ratios, the information ratio is pretty good. Sortino ratio, looking at how the manager protects on the downside to give you that relevant upside capture over the cycle. But it's the consistency of the process and the repeatability of that process, really. It's whether they've got something that is a tangible process that's worked throughout time, and you have a high level of confidence that that process is going to work in the future. And there are certain metrics around that. There's certain flags that you can look at. Having a stable team is one of them. Making sure they've got the relevant experience, not just experience, but relevant experience to the product they're managing. The alignment with shareholders, absolutely critical. Are they invested in their own product? What kind of engagement do they have with both stakeholders, the investee companies and the people invested in the fund? Those sorts of things can paint a big picture. Isn't one particular thing, but a good manager is all of those things and more so. Yeah.
Okay. I think I've got actually a question here on your global equity fund. It says you've got a sort of significant overweight to Europe. Has this always been the case, and could you explain the rationale? Does that make sense to say? I've not looked at it, so I have to confess.
No, it's fine. I have to be quite careful because there's a couple of different products that we manage internally, and obviously there's the CG, the Canaccord Genuity Global Equity Fund, which is managed by a separate team. So I probably wouldn't be best placed to answer that.
On their behalf. Absolutely.
Yeah. So it depends on the product, but generally speaking, the global equity fund will definitely be led by the team's expertise. They've got more of a UK and European centric expertise, and also valuations as well, definitely. And I imagine if it's the fund that they're talking about, which I think they're talking about, there's going to be a material mid-cap bias there as well, which will explain some of that.
That makes a lot of sense. Might be worth just picking up on another couple of these questions. Once again, I think this is the sort of global equity fund. It says has rather large underweight China and other DMs versus the benchmark. What's the sort of rationale behind this? Is that something you can answer, or is that?
Yeah, the global equity fund itself, it's managed by a separate. It's a separate product to kind of the suite that we control from a centralized perspective. So, I probably wouldn't want to delve too much into the rationale behind some of those moves. And it's going to be bottom up as well, primarily. It's not a top down allocated fund. So a lot of those moves will be a byproduct of the process.
Yeah, absolutely. Just obviously talking about the sort of larger funds here. We sort of did have a question that, is probably you're maybe one of the best people to ask about this. Obviously, there's been consolidation in the wealth manager space. And obviously we focus on investment trusts, but sort of with that consolidation, there is a sort of feeling that, trusts may have to expand to keep themselves sort of relevant. Do you think that's the case? Do you think that's a fair comment?
In terms of expand, do you mean?
Well, basically, increase their size.
Yeah.
Perhaps knock themselves together, that kind of thing. So that, you're not, there's the liquidity there. So if you're making big trades, you guys aren't moving the market against yourself.
Absolutely.
I'm guessing it's the underlying thought.
Yeah, exactly. So liquidity is the kind of perma issue with investment trusts and model portfolios, and trying to allocate the same trade across the board is incredibly difficult. Unless it's a huge, monstrous trust, Scottish mortgage or something. But Yeah, no, it's difficult, and it's a question that it can't be answered very easily. I think the
Mhm.
industry will have to get together. The AIC will have to be significantly involved in this,
Yeah,
and how they address these things. I mean, and the regulator needs to be involved as well. It's a huge
yeah,
question. It's
yeah.
like something, yeah, probably above my pay grade at this point, I think. Yeah.
Brilliant. I suppose as a sort of follow-up question to that, are there sort of specific areas that you like to use trusts to allocate to, or are you sort of quite agnostic between that and perhaps an equivalent open-ended fund?
Yeah, I mean, when you have, and the classic one is where you have a manager running two strategies under the same
Yeah,
sort of investment process, and if there's a significant discount on the trust and it's liquid enough, then we would recommend that investment managers purchase the closed-ended.
yeah,
We are happy to use larger liquid investment trusts where it's appropriate, often in income strategies, because you get
mm,
the significant dividend growth drivers of investment trust behind there, with the ability to retain their
yeah,
revenue streams. They can give you a great dividend growth profile over time. That's really useful in income portfolios. We do use global investment trusts as well across the board, so our
yeah,
managers have flexibility to select differentiated vehicles where appropriate for their risk.
yeah, yeah. I suppose sort of related to that, obviously these things can have sort of different fee structures. Um, I'm guessing sort of, do you have any views on fees? Do you tend to find that maybe the investment trust is perhaps a bit more cost competitive on fees, for example?
Yeah, I think since the MiFID fee disclosure and the way that that's been adopted in the industry, that since that's come in, investment trusts have probably been slightly unfairly penalized, the way that they have to insert the board costs and all this
Yeah,
kind of ancillary costs of running the company, and open-ended funds don't have to do quite the same
no,
thing, and so
no,
there is a disconnect there.
yeah,
And the AIC has been very vocal about that and how that needs to be amended. um so in some cases it can be very competitive, and as a large firm like Canaccord, we can often get really good structures on brokerage deals and things like that for
yes,
investing a
of course,
significant amount. So it really depends. I mean, it, fees generally have gotten better over time. They have
yeah,
gotten lower, and I think that's only going to continue because passives aren't going anywhere. And
yeah.
yeah, so it's interesting times.
I guess just on the subject of passives, do you use ETFs and the like when you're sort of asset allocating? Do they form part of
Absolutely.
it? Yeah,
Yeah, absolutely. I think they're fundamental to portfolio construction, in specific areas. So the US is often, you know, sort of spoken about in regards to passive investing,
yeah,
but there's great data behind why that is. I mean, the long-term underperformance rate of active managers in the US is quite stark. You're looking at
yes,
90% over the last 50 years, so rolling 5-year
mm,
returns. It's about 90% underperformance rate. And it's not the same 10% of managers who are outperforming in
yeah,
a subsequent period. So
yeah,
it's an incredibly difficult market to
mm,
outperform. And so having that as a core part of your US allocation makes sense. And
yeah,
um, we've got that sort of structure. We bolt on kind of high active share active managers onto that to try and capture alpha alongside it. So I think a core
mm,
satellite approach in the US is absolutely relevant. In the UK, almost every manager was underweight commodities going into this cycle.
yes,
And so it made sense to have some of that index exposure where active
yeah,
managers were just not going to overweight commodities. Commodities are more than 20% of the FTSE 100. So it's
mm,
very difficult for active managers to
yeah,
go that high in it. So yeah, it makes sense. It's a
yeah.
good part of portfolio construction.
Okay, that makes a lot of sense. Just on the sort of, I guess, the difference between US and UK closed-end funds. I mean, at the sort of risk of perhaps bigging up our own market, one of the nice things I've sort of liked about the UK investment trust industry is that actually it has a sort of strong record of corporate governance. If you're not happy, you can get a board to boot out a manager. If they won't do it, you can boot out the board. If you've got the, you know, sort of number of votes, etc. Getting these sorts of changes in the US is much harder because the sort of thresholds are different, which I sort of think has tended to allow these things to languish on bigger discounts, allow sort of underperforming managers to perhaps persevere for longer than they should be allowed to. Do you have a view on that? Has that sort of been your experience, or did you just really not look at them when you're looking to the US?
Yeah, we tend to sort of stick to kind of the UK side of the market, to be completely honest. And some of your concerns I would echo as well. Yeah, I agree.
We sort of touched on fees a minute ago. Something I wanted to just sort of ask you, your sort of broad view on fees. Obviously, you say they're coming down, expect those to continue. Obviously, you're seeing a few funds, and I think you saw more of these years ago, but then they kind of sort of drifted away. But you're seeing a few funds that have no base management fee, and it's all performance fee. I mean, so how do you feel about those? Do you like that? You think that's quite a good structure?
Yeah, we actually, we have invested in a investment trust that had that structure. Often they're timed, right? So they'll be on that structure for a few years, and then they'll probably bring in a base management fee. But actually, I think in theory, performance fee only completely aligns you with the end investor. So you're not taking a fee whatever the weather and whether you're underperforming for times that you're actually you're eating your own cooking and so to speak. So in theory, it's a good thing. You just want to make sure that there aren't any caveats or clauses in that performance fee that can basically mean that they can capture more of the upside if they reach certain thresholds. And so if it's a good structure and it's aligned with what you want to do as an investor, I think it's perfectly reasonable.
Yeah. Okay. We've sort of got a few more questions here. I'm sort of conscious that the clock is ticking. I guess just in terms of, the audience, they're obviously trying to make their own asset allocation sort of decisions. Are there any other areas that you would point out as being particularly interesting at the moment, or perhaps even on the sort of downside, things you're quite wary of, keen to avoid, that sort of thing?
Yeah, we definitely think it's going back to the US versus the rest of the world, and it's been one of the most narrow markets year to date that we've ever seen. I mean, a handful of stocks have driven the entire performance of the US market. Markets are often skewed in that way, but not to the extent that we've seen. It's incredibly narrow. So lots of other areas look pretty attractive to us. We like Asia Pacific markets at the moment. Global emerging markets look pretty good in the right areas. India's been a great place to be. China, we have obviously got the same concerns as the rest of the investment community. How investable is China? It's an open-ended question, and it's very complex. But we like Asia Pacific more broadly, that we do think there's lots of growth to come out of those areas. As I've said, Japan. On the thematic side, we like infrastructure, we like healthcare. We think those are incredibly good, longer duration plays and have a lot more sort of legs to them over the coming years. Structural growth drivers behind those two areas. Infrastructure, obviously, you've talked a lot about that in your presentation. And healthcare. I mean, we're the average age of the world's population is going up in the Western world. Certainly, we're seeing decline now, and healthcare is becoming an integral part of that story. And small and mid caps, as I've said, that we're marginally overweight mid cap in the UK, a bit overseas as well, globally, and we think there's great value to be had further down the cap spectrum as well.
Okay, super. I think we've got a couple of minutes to go. I'll just see if we've got any other. Okay, just one here that might tie in. Obviously, pandemic accelerated a lot of trends such as cloud computing, cashless payments, etc. A lot of these have sort of crashed back down to earth. Do you think there remains opportunity in some of these spaces, or was it just a sort of case of over enthusiasm? I'm sort of guessing a lot of that relates to, has perhaps the market gone too far the other way? Is that something that you sort of might have a view on, given that you allocate across many areas?
Absolutely. we've got some of that exposure in our ESG portfolios, for instance, with cybersecurity themes or oncology, again, infrastructure. There's lots of different areas that play into that. I think the key is to understand that the stuff that has really crashed back down has been kind of the profitless areas of those subsectors, and there remains a cohort of high quality companies that continue to grow, continue to generate cash and invest really well and soundly for the future. The key issue is valuations, which corrected. It wasn't really the thematics or the growth drivers behind them. Cashless society that's still a mega trend. It's still happening.
Yeah.
Japan, is something like 10% of retail is done on a cashless basis. So a huge area of growth to come for such a technologically advanced country. Yeah. E-commerce is such a low percentage of total retail spend globally, and those trends are going up. So the trends are absolutely sound, but it's the price that you're willing to pay for those trends at the present value. And yes, in some cases, you're getting really good opportunities to do so. I mean, Scottish Mortgage is a great example of that, right? That's all about disruptive innovation.
Yeah.
There's lots to talk about Scottish Mortgage. We started at the wrong time. But that's trading at almost historic discount levels now, 22% discount.
Yeah. I think a lot of the Baillie Gifford funds aren't they? So
exactly. So it depends there's two questions that I would always say to people: what's your risk tolerance and what's your time horizon? And if you can answer those, you probably get a broad idea of where you want to be with those long-term mega trends. But the trends are still intact. We believe that. Yeah.
Super. Look, okay, I think we better wrap it up there. We're sort of 1 minute to 12. But thanks ever so much for coming on the show today.
No problem.
Really,
Thank you
really
for
interesting as sort of as it always is. And I'm sorry, hopefully we'll have you back soon and can sort of kick some more ideas around. But obviously, thanks ever so much. I will now just move on. Just the sort of legal bit, which I am required to draw your sort of attention to, and say if you sort of don't get a chance to read it now, then suggest maybe have a little look back later. And just finally to let you all know that we've got our property investment conference this coming week. That's on Thursday. There's sort of details in the event section if you want to register for that. And then on Friday, I think James should be back with Michael Anderson of Aquila European Renewables. And then after that, on the 26th of May, we've got the guys from Vina Capital Vietnam Opportunity. And then I think there's sort of gap, hopefully we're filling that in, but on the 16th of June, we've got Bearing Emerging Imminent Opportunities. So thanks, Kamal, and thanks, Richard, and thanks everybody for joining. And we'll see you back here next week. Bye-bye.